respond to me through the chat mode while I'm discussing. I'll basically try to introduce you all to the program today. And this is Economics of Monetary Policy and Financial Markets. A very interesting subject from a broader perspective. Not only help you all to gain subject-wise theoretical, technical, and application knowledge with respect to how you wanted to kind of get yourself acclimatized with this subject area. But more interestingly, you also would learn a few aspects of a lot of information in line with what you see in today's financial markets, not only in Sri Lanka, but also across the globe. So you more or less have a wide spectrum of purposes you can tick once you complete this program during this semester. So I will be more or less taking you through a very structured continuous sessions of a discussion, mainly through handouts that you will be seeing. But at the same time, I'll prefer some materials that you've been looked at. So we'll be able to get into those details as we move on with this discussion. And any consideration or discussion topics that you wanted to have while I'm discussing the presentation here, you can either raise your hand. If not, you can put whatever clarification that you are expecting from me in the chat mode, so I can quickly follow up and take you all through on that basis. And to see this, you will be getting handouts every week, more or less prior to the discussion itself. So you will be able to have the discussion slides glance through prior to the discussion. But at the same time, as a habit, if you can build a very good follow-up in terms of what you discussed today in the afternoon itself. So before you start the next day or the next engagement, ideally, if you can take down a few important points that we have discussed in the lecture notes or in your papers, that would be very useful in this program. So what you are simply seeing here is the handout that I have shared with IBSL. They must have already uploaded into the system. So you probably have these handouts with you all, and I'll take you through one by one of these slides to get you a familiarity of what we are trying to understand in this process. So the first area that we are trying to understand today is the basic introductory aspects of economics of monetary policy and financial markets. So from a broader perspective, why you want to study money, banking, and financial markets? So this is a very interesting question that you will come to know, get to know about these topics as we discuss and as we move along. So by looking at any news item that you will come across, particularly with respect to financial markets and monetary, or for that matter, anything to do with economics, ultimately kind of have some implication into what we are trying to study and what we are trying to understand in this program. For instance, in your evening news, even in Sri Lanka nowadays, we see some improvement in financial news. In the past, it was not the case. And even you see in Sri Lanka now, you have some financial press which are of quality and which gives you reasonable insights into how the financial markets and the financial decisions influencing other related variables that we will be studying in this program. But just to kind of give you a hint, in the evening news, you might hear that the Federal Reserve, by Federal Reserve, I'm telling you, it is the central bank in the US. So we'll be studying about Federal Reserve, but just for the time being, you say there's a news item, the Fed Reserve has reduced the interest rates, federal fund rate in the case of US, right? So what basically says is central bank in US has reduced the interest rates by a 1/4 percentage point. 1/4 percentage point is 25 basis points. Each percentage point has 100 basis points. Okay, so in financial market, single basis point is a huge movement when it comes to certain type of transaction. So 1/4 percentage point, 1/4 of a percentage point, that is 25 basis points reduction by the Federal Reserve with respect to their policy interest rates in US. This is no different to Central Bank of Sri Lanka making announcements with respect to the adjustment of Central Bank of Sri Lanka's policy interest rates. You will see that in the press, it is the overnight deposit rate and overnight lending rate in the case of Sri Lanka. The central bank adjusts these rates, and through which a lot of variables in the economy also get adjusted. We will get into those stuff in details, but this is a news item for you. Okay, when you see something like this, what effect might this have on interest rates generally across other type of economic activities? For instance, in this slide, they talk about automobile loan, vehicle loans. Okay, so when you try to purchase a vehicle through a loan, or for that matter, you are intent to go for a personal loan. So what this Federal Reserve's action with respect to interest rates adjustment have on your decisions with respect to this automobile loan or personal loan is very interesting and very important in the focus of this particular program itself. Okay, so what this action indirectly mean that the housing will be affordable in the future. That's the one question you might ask. You see today's interest rates, policy interest rates have been reduced by the central bank in the US. So as a result of this, right, whether the housing prices, housing loans, and how that would look like going forward. So that's something everybody would be very keen to kind of analyze, because financial markets take these directions by the central banks very seriously, because that would drive their path of activities, economic activities that they engage in. Okay, so what also this type of action by the central bank poses in terms of the job prospects that you all have in the next financial year, or for that matter, tomorrow itself. So whether this reduction in interest rates, policy interest rates, have any influence on overall investments in the economy. Increasing investments is positive to new economic activities. That means job creation. So they will look at all these things. So this is a kind of, hint that I'm just putting to you all to see how the Federal Reserve is the US central bank's action would have on various type of economic activities. So in this course that we are trying to understand and study, okay, in fact, the subject of this course is trying to provide answers to these and other questions by examining how financial markets, when I say financial market, it could be the markets for various financial assets, bonds, stocks, even foreign exchange transactions, housing, mortgage, various type of financial assets that you will come across. Okay, so for purpose of this particular program, we try to understand and also try to answer the questions by examining how financial markets we don't stop there. We also look at financial institutions. Okay, markets and institutions here. Institutions are the banks, insurance companies, various type of agencies that deals with financial market related activities. And we try to see how financial markets and financial institutions work. Okay, and also we explore the role of money in the economic activities. So that's the kind of a focus that we wanted to bring in through this program, through this subject, during this 13 to 14 weeks that we might be discussing these things during this semester, in terms of how monetary related aspects influences the overall financial market activity. So this subject is not necessarily something altogether new for most of you all. If you all have studied basic economics, you have studied some of these concepts, but we will refresh them. But overall, what you have to understand here is you will not only refresh them, but you will learn to apply these aspects in how financial market and how financial institutions work. And this would help you in answering your examination related consideration, but also more interestingly in your future path and prospects in terms of engaging in investments, and also to some extent understanding what's happening in the financial markets by looking at the financial press or any leaflet for that matter. Okay, you may have understanding, but you can further fine-tune your understanding with rationality by having a picture of these aspects in this program. Okay, so what we have to say here is not only the markets, financial markets and institutions, they affect your day-to-day life, okay, but also these activities involve huge flow of funds. Okay, huge flow of funds. I mean, it's not like 1 billion, 2 billion, no, it's trillions of dollars. Okay, which in turn affect businesses' profits, the production of goods and services, and even the economic well-being of countries. So the markets and the activities that we are looking at would have greater influence, not only across your personal life and your family's financial well-being, but across the economy and across the globe for that matter. So that's a very interesting aspect, because every day the world is distance-wise shrinking its distances. World become increasingly integrated with respect to the financial markets and of course in real economic activities nowadays, and even labor movements, right? People search opportunities not only in their surrounding, they move out and see options available in terms of their capabilities and their expertise. So this is all creating new sets of challenges in the financial markets in today's sense, and we will focus on those stuff as well in our discussions. Okay, any questions before I move on? Because I always wanted to see if you all are physically present in these classrooms, I can kind of measure your response in terms of the discussions. But when you all are not physically present, at least you can highlight your considerations in terms of just dropping a few words in the chat box, so we can follow it up on that basis. And that's how I would always wanted to see, because it's more or less a discussion, interaction-based subject. And of course, the technical areas I would try to repeat to get you a more clear understanding of the subject area, but would be much more appropriate if you also respond to the clarification I extend, because that would make me to pace my presentation, whether to kind of go fast or slow down a bit, and to see whether how you all understand subject areas with respect to these topics. Yes, you have seen the broader focus, but when we are looking at this subject, right, as I already said, we examine how financial markets, when I say financial market, that's where the financial assets trade, okay, such as bonds, stocks, and foreign exchange. How they work is one focus of this program. And then, of course, institutions, as we already discussed, banks, investments, and insurance companies, even central banks for that matter. Okay, how those institutions work, that is also one of the focus of this program. And then, very interestingly, role of the money, right? So these days, everybody is talking central banks printing money, money supply is increasing. What's the role of this money in the economy? So that's very interesting for us to see. So we will look at those also in this program. Okay, and more interestingly, how central banks set about their business. Why central banks exists? What their focus is, what they wanted to achieve, right? What's their role in the economy? So these are the areas that we will try to understand. And our focus when it comes to central banks, we would look at it from the Federal Reserve, most sought after central bank in the world at the moment, how their actions, how their basic formation and decision making and things like that. But we will link all that with Central Bank of Sri Lanka and also other central banks close to our day-to-day operations, right? We will look at those also. And then also we try to link these financial markets, institutions, role of money, and the central banks into other macroeconomic developments, right? So other macroeconomic developments would help us to understand why the markets, institutions, money, and the central bank behave in a certain way through which they try to influence other macroeconomic variables that has ultimately influence on subjects. Subjects means the people, okay, people's well-being, right? So that's the focus of this program from a very broader sense. And the recommended textbooks for this program is The Economics of Money, Banking, and the Financial Markets by Frederick Mishkin. This book is available in the IBSL library, but also for your information, there are unauthorized illegal copies also in circulation in the World Wide Web. You can search and you might get some of these copies. It's okay if you can read. I have no problem, no hesitation with respect to the materials that you are using. But ideally, if you are having and owning a copy, it would be better that you are looking at any version of this Mishkin's textbook. You will probably have 12th edition now. Any edition above 6th edition would be ideal. That's not much different in terms of the concepts and the way in which the materials being presented. So that's what I'm using as a recommended textbooks. But this is not the only reading material that I'm recommending to you all. I'm just requesting everybody to kind of, keep your eyes and ears open to everything happening around you with respect to financial markets, central banks, and economic affairs. You can listen to the news wires. You can listen to the electronic media. You can look at, read, refer, print media. Okay, so that would help you to understand the broader perspectives of this particular program that we are trying to understand. Right. Why study financial markets? Any questions before that? Right? So you can see things here. Why you want to study financial markets? Right? So very interestingly, the financial markets, financial assets there. It's a market in which financial assets exchange are very, very important for any economy. Why? Because these markets, bond market, stock market, foreign exchange market, right? They channel funds from surplus entities to, one could call, deficit entities, or for entities which has productive investment proposal. It's not only the deficit entities who borrow or who ask you all to channel your excess saving for their institutions or their financial assets that they have offered in financial markets. But also there are institutions, they have highly credible investment proposals, projects that they can take through, but unfortunately they can't do so simply because they have a resource shortage. So they channel these resources from type of entities, savers in the economy, to the other side of the equation, the borrowers. So basically, you invest in their financial assets. So through which you promote economic efficiency. Right? So I am saying economic efficiency, you basically invest your excess in opportunities that you see is creditworthy for you to invest. Otherwise, what happens is you yourself has to go behind and find out what you want, like a barter trade, where goods to goods, if you are having some excess rice production with you, but what you want is a haircut. So you are going with your rice to find somebody who can extend you a haircut. So that's a barter trade. Goods to service. Okay, you give him your excess rice and get him to give you a haircut. So that's matches. Needs have to match. But when it comes to financial markets, you don't need to. You don't need to make sure where your funds are ultimately landing. What matters here is you have to put your money in a credible source of investment, and that investments would take care of where your money being channeled. For instance, financial intermediaries. You save and you don't know where your money is ultimately landing. So it might be for a housing project, it might be for a electricity generation, it might be for a road construction, it might be for a worthy cause of helping education, health, or for that matter, even for misusing and using for various illegal type of activities. That's also possible. But until such time you precisely come to know, you yourself invest your excess savings in this case in financial intermediaries. That's why I said market institutions. But interestingly, the financial markets channel funds from savers to investors to promote economic efficiency. Right? So then you see this market activities that we are referring, right, affects personal wealth. You will come across the concept of wealth have a positive relationship to asset demand, financial asset demand. Higher the wealth, higher the demand for financial assets. We will come to those. Okay, so the market activity affect personal wealth. The behavior of business firms, whether they wanted to expand or maintain or reduce their economic activities already engaged in, all matters. Market activity contributes to behavior of business firms and as a economy and economy as a whole. Yes, if everything is kind of a closed down, like what sometimes you see in terms of how we experienced during the first wave of COVID in this country, you see a lot of economic activities being either closed down on a temporary basis or extended those economic facilitation or economic activities through restricted arrangements or limited arrangements. So as a result, we already know the economy during first quarter of this year has declined, negative growth of 1.6%. So that's impact. The activity of the market has impact on personal wealth. People who could not work, could not get their regular overtime, OT, and extended bonuses, or more income through tips and other things because of people get the services. No, because of the shrinkage of activities, there's some impact to the wealth, the behavior of firms, and economy as a whole. So that also very important aspects with respect to the market activities. So the financial markets are markets you have to understand here in which funds are transferred from people and firms who have excess of available funds to people and firms who have a need of funds. So there are two entities in financial market. One entity is surplus, one entity is either deficit or with an investable proposal. So you channel your excess funds to deficit entities or for entities who have an investable proposal through which you can promote economic efficiency. So financial markets are a marketplace through which you make this transformation or the transfer of your savings to other form of financial assets, and through which the entities either short of funds or have an investable proposal meets their funding requirements. So this is broadly a financial market for you to understand. For you to define, you can make use of the last sentence which describes about the financial markets. That's usually sufficient for examination purposes and things like that. Okay, but for your broader understanding, try to link everything that we discuss in this slide. Okay, so we are moving on. Any questions up to now? Right. So you are seeing here financial markets. We have tried to explain, we have tried to define with a kind of limited information we had with us, but trying to understand what it's from a broader perspective. But when you say financial markets, we don't want to just say financial markets. We just wanted to figure it out. Functioning financial markets, not just a financial market, but a functioning, effective financial market such as what we were mentioning in terms of bond markets, stock markets, and foreign exchange market. These are the markets that you are familiar with, generally familiar with. There are other types of financial markets, derivative market, okay, commodities market, right? There are various type of other financial assets also come into play in different market setups, right? Are key factors, these well-functioning financial markets are key factors in producing high economic growth. Because these well-functioning markets provide opportunities for highly productive use of resources from savers to the needy segments of the economy, through which they produce high real economic activities, and as a result, economies grow. Right? So, well-functioning financial markets is a one step forward in terms of how we are looking at financial markets. Okay, so in this exercise, we will look at, in this program, in this study program, we will briefly, not necessarily go into all the nitty-gritties of these markets, but we will briefly examine each of these well-functioning market types that we just described. Their key features, how we will look at them throughout this course, would be something that you will not forget, not only for your exams, but also for your future application in terms of knowledge that you are trying to gain from this subject. So it's very interesting area, because you will be able to figure it out, not only the technical, theoretical aspects, but also more of applications. And these applications are very key, very interesting in terms of a focus for the exam, as well as from a broader perspective in your day-to-day economic activities in the future. Okay, so then when we study these financial markets, we are also interested in debt markets and interest rates. We will try to define these stuff as we move on, right? Debt markets, or bond markets for that matter, right, allow governments, corporations, and individuals to borrow from surplus entities for the purposes of their financial activities. I normally don't read these slides, but I just get a kind of a feel when I see the slide itself. So I try to explain to you all from a very easy paced language. So if you have any kind of a difficulty in understanding, please feel free to drop me a message until such time we see opportunity that physically the classes could be presented in IBSR. So, but from a broader perspective, I'm just keeping you all always engaged. So you see, while you're attending this class, you will be able to kind of inquire, discuss if you have a difficulty in understanding any concepts here. So that would make not only you, but also the others in the program also get some additional information, right? So when it comes to financial market, as I said, debt markets and interest rates, right, is very interesting two concepts. The debt markets are often refers to bond markets, where the entities who requires funds borrow to finance their activities. Right? When it comes to debt market, they issue a security, either in paper form or now mostly in electronic form. Okay, the borrowers, government, corporation, and individuals, okay, they either issue a security, or even for that matter, if it is an individual, it's a loan, right? So it's also a security for you to kind of transact on the basis of that security alone. But in a more financial assets per se, you see the borrowers issue a security, often called a bond. Okay, this bond promises the timely payment. Very interesting. Timely payment. It's not that tomorrow or yesterday. If that has mentioned as 15th of December is the date in which the interest is due, you have to make sure the payment of interest on that particular date, 15th of December. So the timely payment of interest, and then of course the principal over some specific time horizon. If it is a 5-year bond, we will get into those in much more clarity and detail as we move on to bond markets and how its functionalities. But from a broader perspective, you have to have your heads up before getting to those subject areas by knowing what this bond means. It pays coupon or interest and principal at the time of maturity. Maturity is the final date of lapsing of that bond. If it is a 5-year, it will pay up to 5 years the interest, but at the last point of time, it not only pays the interest due, but also the principal value of that bond. That's why we said the bonds are the ones that promises the timely payment of interest and principal over some specific time horizon. So 1 year, 2nd year, 3rd year, 1st year, 2nd year, 3rd year, 4th year, and 5th year, you see the interest is due on a particular date of this bond. And you will receive that interest payment as defined in that bond, plus at the last point of time that defined in the bond, that's the maturity date, you get the principal also. So what is this interest rate in this sense is the cost of borrowing. Okay, so interest rate is the cost of borrowing, and opportunity cost of holding money in your pocket or in your wallet is the foregone interest rate by investing them in a investment financial asset. So you have in your wallet, let's say 5,000 rupees. So that 5,000 rupees effectively being in your wallet would not bring you any return. If you have invested that, you will get a return, which would be the interest rate. Okay, so whoever make use of that 5,000 rupee that you have invested somewhere in his economic activity has to pay the lender. Let's assume you have put your money in a financial intermediary, bank. So the bank would pay you interest, but the person who borrows from the bank that 5,000 rupee that you invested has to pay to the bank also another type of interest rate, that is cost of borrowing. So from a broader perspective, the interest rate is the cost of borrowing. And opportunity cost of holding money in your wallet is the interest rate. Okay, so these are also some aspects that you will try to understand as we move on with this course for your discussion. And when you say interest rates, there are many different type of market interest rates. You see the mortgage rates, car loan rate, credit card rates, various type of interest rates. right? There are some other formats of interest rates also: floating interest rates, fixed interest rate, adjustable variable interest rates, index linked interest rates. We will not confuse you with all that for the time being, but you will come to know some of these concepts as we move on. But these are different type of interest rates that you come across. And these interest rates also not same across different time periods. There are different levels of these interest rates. It's like your height, right? So when you were in the kindergarten, your height is some different number to what you are today. I'm sure the probability of further going up in height is now fast diminishing as we become to a certain age in terms of our adulthood. So it's not possible beyond. But from a little age, you see the height also changing. So interest rates also at different stages, it's different. The levels are different. So when your economy is having a high inflationary environment, the probability of having a high interest rate is greater. But when your economy has a low and stable interest rate environment, the interest rates levels also appears to be lower. Okay? At different periods of time, you can measure this. For instance, in the US case, the mortgage rates in the early part of 1980s were more than 10%, double-digit numbers in US at that time. But now it's about 3%. And sometimes even lower. Because current interest rates level in advanced economies, OECD economies, are very low. And even for that matter, in Sri Lanka also, you see now the interest rates have reduced. But this was not the case a few years ago. Even in the recent budget, the government has proposed, and it's been broadly approved because now the third reading continue in the parliament. So until we see the third reading also concluded, some changes may occur, but broadly, housing loans for salaried employees being proposed to cap at 7%. That was the one budget proposal. And you probably see interest rates being capped for housing loans at 7 based on that yardstick. But the general housing loans that we are familiar with is double-digit numbers. So these interest rates at different periods of time also changes. Okay, any questions? Right. So you see this different type of interest rates. And then we also see the bond market and the interest rate. And as I said, in the bond market, we normally say a financial security. Okay, it's a financial instrument. Bond is a security, a financial instrument that provides you a claim on the issuer. If it is government issues treasury bonds. Treasury bond is a security which is a claim on the government's future income or assets by the investors. So when it comes to bond market, you probably see a security. What is a security? It is a claim on the issuer, government, corporates, or any individual, whoever who issues a bond, it's a security now, and that security is a claim on this issuer's future income or assets. So whatever the bonds that the government issues being serviced by future budgets. The budgets provide servicing of these in their budgetary presentations in future for each financial year based on already built up obligations. So anybody who invests in this bond has a claim on the issuer's future income, or for that matter, assets. If anything happens, you can claim over the buildings of the government or the other financial assets or real estates of the government, right? So they can liquidate those and service you their obligations. So these are all possible. And when we say a bond from a very broader perspective, as we were discussing debt markets, so it's a debt security. Okay? That debt security makes promises to make payments, as I was explaining to you in the previous slide, periodically for a specified period of time. When we say a bond, as I said, they pay interest, timely payment of interest and principal at maturity. So this periodical payment for a specified period of time is another feature of a bond. Why it is important to say periodically? Because mostly the bonds carry coupons. So these coupons are either a promise to pay you the interest every half a year. That's the most common type of coupon all around the world. Or it could be every 3 months a time, or 1 year annual basis payment of coupon. That's also possible. But most common interest payment structure of a bond, the coupon payment, that is known as coupon payment, is 6 monthly, if not semi-annual payment of coupons. So they specified 6 monthly. The first 6 months, if you say it is 15th of December, the next 6 months would be 6 months from 15th of December. That would be 15th of June. Right? So ultimately, if it is a 5-year, assuming this bond being issued in 2020, it would be 2025, right? June 15th. Assuming the bond being issued in 2020, June 15th. So 6 monthly cycles, 15th of December, 15th of June every year, you would see 6 monthly periodic payment of interest. So bond is a debt security that promises to make payments periodically for a specified period of time. And you already know what is the interest rate is. It is the cost of borrowing, or from another perspective, the price paid for the rental of funds. You rent your house, you get rentals. You have a rental income. You have upstairs, nobody lives in that upstairs. You rent out that and you receive a monthly or annual rental income. So similarly, okay, you rent your funds to a financial intermediary, or you rent your funds in an investment, financial assets. So for that, whoever borrows has to pay a price. That price is the interest rate, that is the cost of borrowing as we described. So you see very interesting concepts now itself coming out in terms of this subject area that we are discussing. Any questions? I just now said that the economic growth declined in the first quarter, first 3 months of 2020 by 1.6%. Negative economic growth of 1.6%. That is Sri Lanka's economy declined by 1.6% in first 6 months of 2020. First 3 months of 2020. That is what Department of Census and Statistics in terms of their GDP numbers announced. For the second three months, that is from April to end June, that is the second quarter, and the third quarter from July to end September, right? The DCS proposers, they would provide the GDP estimates together simultaneously, like towards middle of December. That's what we also hear from them. But interestingly, the global economic growth in 2020 is projected to shrink. You can read IMF's World Economic Outlook, WEO. If you type in Google World Economic Outlook, IMF latest World Economic Outlook would say the global economy is going to shrink 4.8% in 2020. Globally, the economies are going down. The countries whose economies, for instance, UK, they had 20% decline in their economy during the second quarter. India, more than 10%. Already they have announced the numbers. The China, right, they had 8-9% growth. The economy has grew only by 1% or so in the first half, right? So there are various countries have different kind of economic growth numbers based on their economic structure. But 1.6% negative growth I explained to you all, is Sri Lanka's first quarter economy's negative growth. That was a question raised by one of y'all. So it is negative economic growth for Sri Lanka, not for the world, but world economy also expected to grow negative in 2020. That's the projection. And now we have seen it's almost December. So 11 months have lapsed. This is the 12th month. We don't see any miracles happening to see the world growth is suddenly increasing, magnified by many times. That's not expected. Everywhere you see some form of restriction is put in place due to the prevailing pandemic. And even now you all see, you all are participating to this program through online arrangement. Yes, new economic activity expanded in terms of online engagement. But at the same time, if not for the pandemic, you would have used a transportation, right? You would have used traveling from your residence to the IBS. You would have kind of utilized other services in the form of canteens, in the form of dresses, in the form of shoes, in the form of perfumes, in the form of many other things, right? So that's some engagement of economic activity by many economic agents. Still you engage some form of economic activity, although being not necessarily using the other form of usual economic activities. But this has varying impacts to the economic growth. So this is happening everywhere, in every country, in current circumstance. So therefore, we do not necessarily see economies to be very high positive growth numbers in 2020 all around the world. And in fact, world growth is expected to be negative in 2020. Sri Lanka is either break even or marginally negative. That's what we expect at the central bank. So you already seen some of these classification and clarity in terms of bonds and interest rates. So you can now see some conceptual insights into interest rates itself, and it is the cost of borrowing or the price paid for the rental of funds. Okay, so you can see these elements, and you can see here again interest rates. We have simply said different levels of interest rates at different time periods in the world and in the history. Even today, we might see interest rates. That interest rates would not necessarily be the same 1 month from now. It may change. But we are here seeing even with bonds, interest rates would be different. Even bonds that you come across, even bonds issued by the same issuer, government for that matter, you might see interest rates are different. You can see from this slide, US Treasury, US government, long-term bonds, which are in red color, and US government treasury bills. Bonds and bills have a difference. We'll study those stuff as we move on. In light blue, and then you see corporate BAA. BAA is a rating, credit rating. We will learn about credit rating also. We have a separate section on rating arrangements. Okay, so corporate BAA bonds, which are in a greenish blue color, right? So you can see these different colors, but what interestingly reflects here is the different levels of interest rates at different times, right? The interest rates also behave differently. And what you basically see is shorter the tenor, 3 months, the duration, generally interest rates appear to be lower than longer tenor financial assets, in this case bonds. US Treasury bonds are longer in duration than bills. So red line is above the light blue line. But then you see another aspect here, the corporate bonds, which appears to be the costliest in this graph. You have to pay more for corporate bonds. That comes with the issuer. It is not the US government, but this is a corporate, private entity. So the private entity borrowing from US citizens or institutions or global investors have to pay more in return as interest rates than what US government's bonds pay or bills pay. That comes with the issuer's credit worthiness. We will discuss about those stuff with credit rating once we move on to that. But from this chart, what you have to understand and kind of acclimatize is that the interest rates levels are different at different times across the history as well as expected in the future. But interestingly, same financial type of financial assets would have different interest rates based on the issuer and also the duration of those financial assets, right? So longer the duration, uncertainty is high. Shorter the duration, uncertainty is low. Understand, you are reasonably certain you will live for another, let's say, 1 week based on circumstances, but you are little more uncertain that you will live longer, like 5 years, 10 years. Anything could happen. Okay, so that comes with the duration aspect. So closer the finish line, you see, you are certain that you will finish the race, or for that matter, you are more certainty in terms of delivering that. But longer the finish line, uncertainty is greater. So then you have to pay for that uncertainty also. The financial assets price these things. That's what you are seeing here. But we will get into those with more structured analysis going forward with respect to the pricing through different theories that explains the behavior of the financial assets. So that's the message I want to bring in from this element. You see, in terms of duration, in terms of issuer, in terms of levels, interest rates are different. Okay, any questions?
So can you repeat it again for that uncertainty and certainty of that interest rate, the effect of the interest rate?
Right. It's an interesting question, because you see, when it comes to any activity that we engage, and particularly with respect to our funds being rented out, that is, that you invest out, right? If you are certain that your funds would be returned and the time duration for that return contract is shorter, probability of unwarranted things happening is lower compared to a longer duration where uncertainty of anything could happen is greater. So shorter the duration, you see comparatively higher certainty on delivering on promises by the agency in which that you have put your money, or financial asset for which that you have invested your money. But longer the duration, right, even if it is the government, right, number of times the governments could change, number of times the presidents could change is greater compared to more certain path for the next few years in terms of your electoral map. So you see, shorter duration financial assets, right, purely on duration basis carries a lower interest rate because people are a little more certain. Therefore, the borrower or the issuer do not require to compensate you for uncertainty that much. But longer the duration, they have to compensate simply because the probability of unknown things happening is greater. Okay, so that's why shorter the duration, uncertainty is lower. Longer the duration, the probability of uncertainty is greater, and then financial assets reflect. But this reflection is one element of pricing of financial assets. There are other elements that could change that complexion from a very different perspective. So assuming so-called ceteris paribus condition in economics, other things constant, condition, you see longer the duration that carries higher interest rate compared to shorter duration financial assets that carries lower interest rates. I hope that that clears your consideration.
Thank you, sir.
Right. So what you are simply seeing is another slide here, which details out the government of Sri Lanka's international sovereign bonds. Okay. So Sri Lankan government not only issues bonds in the domestic market in the form of treasury bonds. Sri Lankan government also issues foreign currency denominated Euro bonds. What is Euro bond? Forget it for the time being. We will discuss those stuff in detail. So Euro bond yield rates also different at different time periods. You can see here across a longer duration, number of bonds the government of Sri Lanka has issued has behaved at different levels. Yield rate increases, decreases, remain reasonably stable. But in recent weeks, we see rates have increased, various reasons. And generally, I mean, what we are simply seeing is not only Sri Lanka, but across frontier and developing economies, the interest rates have increased for their foreign currency borrowing due to current global economic circumstances. Okay, so this also another element that you will come across in terms of explaining. I mean, if you look at financial press is highlighting these things every day in their commentaries in the newspapers and even in electronic media. We see a lot of explanation, but by learning this program, you yourself have enough ammunition to discuss these concepts, why it's behaved like that, why the rates have increased, why it's decreasing, right? So all kind of things that you can interpret, but interpretation of such things has to have economic rationality. That's what you are studying from this program, right? So we will move on. So we discussed about bond markets very broadly, very little, right? So stock market is another form of financial market which has financial assets being exchanged. There are various types of stocks. You probably see the most common one is the common stocks. Okay, so when you are a stock market investor who owns stocks, and these stocks are common stocks, what it represents is a share of ownership in a corporation. You have invested in corporation ABC, you are an owner. You have some ownership, maybe significant, maybe a very little, negligible, a share of that company, right? Doesn't matter. What matters here is you are a stock owner, and that is a financial assets that carries probabilities of high return, or because you are an ownership stockholder, you also run the risk of sharing the losses of the firm. If anything goes bad, you have to share that. You are owner. If anything goes right, you have more rights to share that than others. Okay. So what's a share of a stock is, again, a claim on the residual earnings and assets of the corporation. Not only the earnings, but even retained earnings, residual, or for that matter, assets, buildings, materials, all kind of things that the corporation owns is owned by the stock owners. So it's a claim on those. A stock is a claim on those. You know what's a bond is, right? It's a claim on. We have discussed those stuff, right? Similarly, stock also has a claim on some of these elements. Okay, so we are continuing our expedition. We are talking about why we want to study financial institutions and banking. That's the focus of this program. We talked about markets to some extent now. Now institutions. Institutions are also very, very important in this program because they are the financial intermediaries who sits between the saver and the borrower and provide both parties so-called economic efficiency services. So the financial intermediaries are the institutions that borrow funds from people who have surpluses or saved and make loans to the other people who probably require funds for various purposes. And a very conservative financial intermediary in the form of a bank, the conservative banking function is you accept deposits and make loans. You accept deposits from one side and extend loans from the other side. So that's very, very basic and a conservative function of banks, because today's banks balance sheets would tell you that more money being made by banks, not through the difference between deposit interest rates and loan interest rates. No, they have fee-based activities, commission-based activities, investment returns, various other types. So that's more or less has a bigger share in today's context. That's why I said this is a conservative banking activity. So then you talk about other financial institutions. You see insurance companies, finance companies, pension funds. In Sri Lanka, you probably see ETF, EPF. Those are contractual pension funds, obligatory to some extent. Then you see mutual funds, unit trusts. Mutual funds are unit trusts, and investment companies. So these are kind of, financial intermediaries generally across the globe that you will come across. These are reasonably common financial intermediaries that you come across not only in Sri Lanka, but also in other parts of the world. Then through financial institution and banking programs like this, you also learns about financial innovation and also become, right, parts of financial innovations in the future. Through this learning, you will be able to kind of, design financial assets. And you should be able to sell that and market it and get recognition. So that's another aspect of studying this type of programs. So when you produce such a financial innovation, you also require to have some acceptance in the form of, some basic foundational background. So that background being established through this type of program. So the financial innovation, that is the development of new financial products and services, is also one of the purposes of this type of programs, why you wanted to study these things for that purpose too. This financial innovation can be a very important force for good by making the financial system more efficient. That's why I was telling, it's generally, you see fixed interest rates, financial assets. But world has realized fixed interest rate has benefits as well as disadvantages, the pros and cons. So to say that, markets have developed floating rate financial assets. The floating rate assets also had differences, and then they had defined indexed linked financial assets. And then, of course, that also being not sufficient, they have gone on to bring in so-called derivative products. The products, financial assets, which derive its value from other financial assets, underlying financial assets. So various ways of expansion in financial innovation is also an interesting element, an interesting contributor to make your financial system more resilient and efficient in today's context. So financial innovation is also need to be looked very positively. Any questions? Right. So you see here, the stock prices also being presented across different periods, and these are US. Okay, so what you are simply seeing is the green line, which is 1950 to 2010, 2011 period, like in US, so-called Dow Jones Industrial Average. So it's an index. It's not a one company, but the industrial companies being pooled and developed an index. So that index was generally behaving, not actually growing, but very conservatively growing up until mid-1980s. And then you see the sudden jump in growth in industrial related stocks in the US, and that contributed the Dow Jones Industrial Average to vastly grow from mid-1980s, then up to late 1990s, and then a sudden collapse. Then again from early 2000s, it again started really going up until 2007 like, and then a crash. Again it's declining, and this is mainly attributable to the so-called financial crisis in US and rest of the world. Global financial crisis in 2008. You know, the number of financial intermediaries collapsed, and there were movies also. Okay, so even you can watch the Keynes versus Hayek, a very nice song of the Maynard Keynes, Keynesian economics versus Hayek, Austrian economics. You can type in Google and see, right? And there are a lot of financial crisis related movies, right? How the financial intermediaries collapsed, what happened, what was the reasons behind, all kind of things. You should watch those stuff. So that would give you some insights into how financial markets behaved at different periods of time. So you see global financial crisis in early 2008, and then financial markets crashing up until late 2009 like, and then some recovery. And from there onwards, you see blue lines. It's from 2010 to 2019 up until recent years. You see the industrial average value some from 10,000 index points to basically now sitting about 27,000, 28,000 levels. So you can figure it out from here. Between different periods, it's reached about 15,000 index points by 2006-7, and then it's again fell down and then returned to 13,000 levels by 2010, and some mishaps, and then you see again it's continuously rise, and we would like to see 2020 numbers. Of course, there's some volatility, and up until last month, where the US and some European announcement in terms of vaccine being developed for COVID-19. So some improvement in stock markets all around the world was noted. So we can see these movements going forward. But interestingly, what you had to learn from this behavior is, like one market, different levels, different interest rates that we have noted, the stock prices also varies across different time periods based on economic developments. So you should be able to look at them and interpret and explain. So to have that background being established, you had to study. You had to study these programs and then get a kind of a rationality. Why this happens? Why the stock market collapsed? Fine, stock market collapsed because of global financial crisis. You will be able to explain, okay, then interest rates decline. So interest rates being forced to decline by increasing money supply, things like that. We will discuss those details when we discuss about financial crisis in this program. So this is the kind of behavior that you are seeing in stock prices, right? So as I just mentioned, financial crisis also a part of the discussions that we will be having in this program. Financial crises are major disruption in financial markets. Major disruptions. You know what financial markets are, right? There are days where financial markets have not at all functioned. So-called Black Fridays, right? So there are periods like that. So when the financial crisis happens, the markets basically disrupted. Okay, and this disruption is also characterized by sharp decline in asset prices and the failures of many financial and non-financial firms. So what's the reasons behind financial crisis? What leads to a collapse of these markets would be a focus in some of these discussions. Right? So these areas also being looked at in this program as we move on. Any questions? Before I move on, explaining on some further details on this subject area. So we also look at, right, the role of money and monetary policy. This is mainly the central bank's focus. Okay, so interestingly, there are enough literature that suggests that money plays an important role in generating business cycles. What is a business cycle? Business cycle is a long duration behavior of economies. So if you plot GDPs of a long duration, you probably see the GDP growths at certain periods are continuously growing. And there are periods then you probably find GDPs are declining. And then come to a point it's bottoming out, and then it starts again increasing. So this is like a cycle, increasing, decreasing, plateauing, and then again increasing. right? Then reaching a peak and again declining. So it's a cycle. So the business cycles reflects the longer duration, longer time period, the behavior of economies. Okay, so there are evidence to suggest that the money plays a very important role in shaping these business cycles. Okay, through money you can create these business cycles to reasonably well behave. And if you look at these, the economic behavior, probably you see across different periods the economies would be growing, but with spikes, then of course collapses, and then of course you see again recoveries, then again declining phases. But on a general trajectory, compared to last 10 years, the recent 10 years would have some improvement across the economy. But the pace in which those economic behavior movements were reflected in these business cycles. That's why I said it's not only the growth, there may be positions, points where you see recessions. Recessions are negative economic growth, where the unemployment increases in the economy. And then expansions, this is growth pace, which again impact all of us to increase our employment, increase our wealth, recessions and expansions. So these also part and parcel of economic behavior. So the money plays an important role in shaping these business cycle behaviors. Okay, so the monetary theory, we will not get into those aspects in this program, because monetary theory is a very deep and interesting subject. If somebody is really wanted to do something with respect to their postgraduate studies, you can think of, but we would not get into those greater details of monetary theories, but we'll try to kind of touch upon the broader basic parameters in this program. Ties changes in the money supply, changes in the quantum of money available in the economy, that is money supply, quantum, volume of money available in the economy, that is money supply, to changes in aggregate economic activity and the price level. Aggregate economic activity is the aggregate demand, and the price level. Price level is the inflation. Right? So the money and the monetary policy aspects, we would try to broadly touch upon the basic principles and not going inch beyond those concepts, because the monetary theory is a separate subject and it requires a reasonable background in a certain economic backgrounds and concepts. So we will leave out for further studies if anybody is interested in, but we will touch upon those stuff to see that so-called quantum of money available in an economy at any given moment of time has some linkage in terms of aggregate economic activity, that is the growth numbers or the GDP numbers that we are looking at, and the price level, that is the inflation. So higher the money supply, you probably see interest rates generally comes down. So when the interest rates comes down, you probably see investable resources are available for market participants to engage in economic activity. So the economic activities could recover or take a growth path in such circumstances. But with that, you see people's income increases, people's demand increases, and as a result, the prices too could go up. So the inflation could also pop up during that periods of higher money supplies. So to balance that, the monetary policy has to play a very important role. So we will see what's the focus of monetary policy in this subject area as we move along. As we discussed here, the money, business cycles, and inflation, the aggregate price level, which is what we usually see in terms of today, the Colombo Consumer Price Index, National Consumer Price Index, different aggregate price levels, which describes the average price of goods and services and economy. You see, when it comes to CCPI, Colombo Consumer Price Index, it's the average consumer behavior being indexed and monitored across different time periods, how the average consumers prices in the basket of goods and services identified in the index behave. So probably you, me, or anyone else who consume goods and services not as similar to the average circumstance reflective in CCPI would have a different inflation experience. But we wanted to generalize it. The economists wanted to see how general prices behave. So they bring in so-called average price of goods and services and then look at average consumer behavior on that basis and see how the prices behaved at different time periods. So that's what the aggregate price level is trying to explain. And when you say this price levels that we are talking about has a continual rise, it is continuously increasing. So we call it inflation. And inflation affects all economic players. So yesterday's money is not sufficient for us to buy same goods and services today if inflation has pushed the prices up. So you had 1,000 rupees of earnings. The 1,000 rupees of earnings is same today too. But if the prices of goods that you have purchased yesterday has increased by 20%, what you can buy today by the same amount of price is 20% less in goods. So which affect all economic agents. Okay, so what you are trying to see here is some aspect of correlation or the connection between quantum of money, money supply, and the price level. And there is a reasonably strong relationship prevail up until 60s. But since then, increasing money supply is not necessarily pushing the prices up. There are other elements that plays important role, and the central banks also started anchoring inflation expectation and managing inflation through changes to money supply and other tools that they have. So we will get into those stuff a bit on this program to see how we can define those elements. Any questions? Right. So you see here, the money growth, there are different M numbers that we would be looking at. So you can see from M0 to M5, whatever higher M's in explaining money growth, money numbers, money supply numbers. But what is interesting here is when you look at any of the M's, starting from most liquid, currency in circulation, most liquid, then you add on different layers of other types of monetary stock in an economy, and that's how you build higher M's. Okay, so we don't need to worry too much about that for the time being, but this chart plots the growth of M2. Okay, so it's growing, and then that means the growth is positive most of the time. It's not negative in any of the periods that highlighted here, but in some periods, the growth is from like 3%, it's hitting almost like 14%, 13%. For instance, 1970. Similarly, in 1975, you see 6% growth has increased all of a sudden, like to 12.5% line. So then you see a period of continuous declining growth. That means money supply is not necessarily declining here. What is declining is the growth of money supply. So you see still the sandwich is flattening. Sandwich is kind of, becoming bigger, right? Because you add layer on layer, layer on layer, like, you are adding on the sandwich, but the addition that you are making this year is greater, bigger or thicker than what you are going to add the following year. It's the pace in which this sandwich is getting bigger, right? So the stock of money is increasing generally across this period, but at different paces. Since 1982, like you see, its pace is declining until like 1992. For about a decade, you see the growth in money is declining, but interestingly, you also see paled lines, vertical lines across these different periods of money supply growth. What these paled lines reflect is the periods in which US economy had recessions. Recessions is negative economic growth. The latest direction is 2008 financial crisis, as I already said. You can see a shaded area, but still money supply is increasing. Money supply from about 5% growth levels in 2007, like it's going up to about 12% growth levels by 2008-9. But growth during this period is negative. And similarly, in early 2000s, you see money supply is declining there, the growth also declining. So this period is partly dot-com bubble related in early 2000s. And also in early 1980s and early 1970s, mid 1970s, these were the oil price shocks, right? The oil prices increased. As a result, the US economy had experienced negative growth. So these are the elements that you see in terms of money growth and then business cycle behavior. So we try to kind of a link when the money supply being expanded, thereby cost of financing being reduced, but still economy did not grow for reasons of other factors. So we will get into those stuff and try to understand those stuff as we move on in this program, right? So we will be able to kind of detail these things as we move along. Any further questions? If you have any questions, you can just drop a line in chat, or you can raise it by a question indirectly, so we can clarify them before I move on discussing these things in details. Right. So we can see this element that we are discussing here. Then another chart which also describes so-called price levels, aggregate price levels, inflation, and then money supply. And interestingly here, the blue line, as I was mentioning, to some extent, the aggregate price levels were generally increasing, but money supply also increasing at a kind of a more or less a reasonable pace in line with the inflation, GDP deflator inflation measured here. Red line and the blue line behave orderly up until early 1980s but then see money supply, which is actually increasing at a much faster pace, but inflation being well anchored, managed. And effectively, sorry, this describes the basic parameter where you probably heard about Milton Friedman. Milton Friedman is known to be one of the pioneers in monetary theory, monetary economics. In 60s, he was well articulate to say that inflation is always and everywhere a monetary phenomenon. Inflation is always and everywhere a monetary phenomenon. You type this in Google and you will get into greater details on Milton Friedman. You can read it. These are readings that you should do, particularly with respect to this program. Right? So during that period, there's a correlation. Whenever there's an increase in money supply, that would correspondingly contribute to the increase in aggregate price levels, inflation. But since late 60s and 70s, except oil price shocks related price increases, you probably see the price increase being managed despite higher money supply growth. Higher money supply growth, because central banks all around the world have, to some extent, mastered the art of managing inflation. And to great extent, this is also a complaisance behavior that contributed to 2008-9 financial crisis, right? So this is also an area where you can explain in terms of price and money supply relationship in a more rational sense as you move along with this program and studies. Right. So another element here is the countries whose experience in terms of money growth rates and inflation. You see, the countries who has higher money supply growth rates had higher inflation, but countries whose money supply is well managed, their inflation's also been managed, right? So you can see here the countries of OECD who had more or less managed the growth and money supply growth, and also their inflation. But these numbers are for 2000 to 2010 period. But some of the countries like Turkey and the Ukraine also, for that matter, now they're also well behaved in terms of inflation management, right? So some countries who are Latin American countries who are now having difficulties, they have replaced the countries in that period in terms of high inflation and higher money growth numbers. But you are basically seeing here is there is a positive correlation in terms of money growth and the inflation. So I prefer to stop at this point today and start from money and interest rates at the next discussion, preferably next Saturday. Next Saturday, yes, as usual, class starts. So any questions that you have before we I move on to and there's a question here, but this question is again with respect to money supply and interest rates. In order to increase the money supply, central bank should reduce the interest rates. No, not necessarily. What you can simply see here is by increasing money supply, you can bring interest rates down. Because when the money supply is available in the market, more money is available for economic agents to engage in economic activities. So when you see more money, it is a liquidity fact. So you have more liquidity, and liquidity would drive interest rates down. So when money supply being increased, it invariably contributes to reduce the interest rates through liquidity channel, or at least protect or kind of check possibilities of increasing interest rates. Okay, so in a sense, what you are simply seeing is across the world, most of the central banks are trying to kind of contribute to economic activities in difficult COVID and other related circumstances by maintaining high liquidity numbers, through which interest rates also being maintained at a low and stable levels. So we will elaborate on this as we move on too. So any further questions? If not, we'll meet next week. Stay safe and take all precautions in the current circumstances. And please read some of the areas that are highlighted through financial press or whatever. Thank you.